Local stories, local voices. We're localwebradio.fm.
Welcome to Sound Investing with Byron Striloff, Senior Investment Advisor at CIBC Wood Gundy, and recognized by Vancouver Magazine in its selection of top wealth makers in Vancouver for 2013. And now, here's your host.
This is your host, Erik Reynolds, and I'm here again with Byron Striloff, Senior Investment Advisor at CIBC Wood Gundy. And today we are talking with Byron about gold and its ability to act as a hedge against inflation. Now, we will discuss how a hedge works, how inflation affects investors, and what assets will offer protection against rising inflation. Now, before Byron joins us, just as a reminder that if you do have questions or require assistance, you can reach Byron at 604-535-3700. Again, that's 604-535-3700. Now, Byron, as always, it's great to be talking with you again today.
Oh, I'm glad to be here, Erik.
Well, Byron, our subject today is gold and its ability to act as a hedge against inflation. Now, I know there is a large concern that excessive printing of money by central banks will lead to inflation, and gold is considered, an inflation hedge. Now, before we talk about gold, Byron, could you explain to our listeners how a hedge works?
I've always said that inflation is a stealth enemy to savers and investors. Inflation causes money to lose its buying power over time, and the basic reason for that is we have an increase in the volume of money and credit relative to the available goods and services in the marketplace. So, in simple words, your dollar will buy less tomorrow than it does today. When you're working, your wages generally, rise with the cost of goods and services, or as the cost of goods and services increase. And typically earnings, they try to keep pace with inflation. So normal inflation is not generally an issue. However, when you're living off savings, inflation literally robs you of wealth because it destroys your purchasing power. I mean, inflation is bad enough for people working, trying to raise a family, but it's devastating on retirees because most of them are on a fixed income. So, and as a rule, I've found that most people underestimate the impact inflation will have, on their retirement plans. So basically, a hedge is any investment that is considered to provide protection against the decreased value of a currency, which is your money. And having an inflation hedge typically involves investing in an asset that is expected to maintain or increase its value over a period of time against the fall of a currency's value.
Well, Byron, so I understand that inflation causes my purchasing power to decline. But how does inflation affect investors who have money invested and are making a return on their capital? Now, does that offset the effects of inflation?
Erik, it really would seem so, but not really. Certain investments might seem to have a decent return, but when inflation is factored in, they can actually suffer a loss in value. Now, for example, and I'll make this simple, if you invest in a bond or a deposit that gives you a 2.5% return, but inflation is 3%, well, obviously you're actually losing purchasing power. But that's before you consider income tax. Taxes have to be paid on investment income. And if we take that same 2.5%, the after-tax return of that deposit for the average family and their average wage would only be 1.5%, which means at a 3% inflation, you're losing 1.5% on your money. Now, 3%, and the reason I use that, that's what advisors use as the long-term average for inflation for long-term or retirement planning. I remember the 80s when inflation was over 10% and GIC-type deposits, they were paying 15, 16, 17% for 5 years at a time. I mean, people were making retirement decisions based on 15 to 17% money, not realizing that after tax and inflation, they were actually losing 3 to 4% of their purchasing power or the value of their money. So they're retirement savings, they were being depleted every year while they were earning 15 to 17% in deposits, and that was a hard concept to get people to understand. In fact, I'm just looking at a little graph I brought up quickly here of the inflation rate in the United States during 1981, and I had forgotten it was. Oh, I'm sorry, the prime rate. The prime rate in 1981 in the United States was 20.5%.
Oh.
That's what short-term deposits were paying. The core inflation at that time was 13.6%. I just forget whether Canada was a little higher or a little lower, but we were certainly right up there with them. A 48-month car loan was like 17.5%, and a 30-year mortgage rate was 18.5%. I mean, could you imagine paying 18.5% on a mortgage rate today?
Byron, you're literally breaking my heart talking about 18.5% on my mortgage. But it does bring us back to our main question, though. Does gold actually act as an inflation hedge? I mean, should retirees or anyone concerned about losing purchasing power of their income or savings invest in gold to hedge against the loss of purchasing power of their retirement income?
Well, I'll tell you, one of the most common questions I receive, and especially in the last couple of years, is, should I buy gold as a hedge against inflation? And many, if not most investors, they seem to think that holding gold is a good way to protect themselves against unexpected price hikes. Now, in my opinion, they're wrong. Gold is often held up as an inflation hedge. However, if we look at the data, it provides a bit of a challenge to this view. Now, right now I'm looking at another chart here. I had to pull up a couple of these because it's hard to remember all this data. But the chart I'm looking at shows the decade-by-decade average inflation rate and the real return to holding gold over that same decade. And I'll tell you, it doesn't support the viewpoint of those who believe gold is an inflation hedge. Now, while gold can help offset some economic and geopolitical risks, it seems to be a poor hedge against inflation. For example, in January of 1980, the price of gold hit the then all-time record of $895. It actually went over $900 at an intraday high. But what happened after that is worth looking at, because gold plummeted in 1981, and this is a year when inflation was 8.9%. And in fact, it also fell through the sharp recession of 1981 and early 1982. And by the end of the year, it had fallen to $590, which is a drop of more than 30%. But by March 1982, it was down $316. So that's more than a 60% decrease. So during March 2002, gold traded at $293, below where it was 20 years earlier. So the inflation rate for the period of 1980 to 2001, it averaged 3.9% per year. But our gold investor, if he was unlucky enough to have bought at that $895 peak, not only would he have seen his investment fall by about 65% in nominal terms by 2002, but he also would have experienced a real loss in purchasing power of about 85%. So if we look at this rather poor performance, I don't think gold can really be considered a good hedge against inflation. This view that gold is a hedge seems to reflect a belief built up about 30 or 40 years ago from about 1973 again to 1980, and that was a period in which inflation was generally over about 6% in the U.S., and gold did increase dramatically during that time.
Now, Byron, we're up against the break, but you can't leave us there with the conversation, so we do need to come back. So we'll be right back with Byron Striloff, Senior Investment Advisor for CIBC Wood Gundy. And when we return, we'll be discussing gold and its ability to act as a hedge against inflation. We'll be right back.
More Sound Investing with Byron Striloff after this.
Buying or selling a home on the Semiahmoo Peninsula? Catch up on local market conditions on This Week in Real Estate with Lance and Connie Marples from Sutton West Coast Realty on localwebradio.fm.
If you're struggling with a dental or oral health issue, be sure to catch the Healthy Smiles Oral Health Show with Dr. Norm Ickert on the Health Channel on localwebradio.fm.
Shopping for the lowest mortgage rate? Looking to refinance? Catch the Mortgage Newscast with Jared Dreyer on the Business Channel on localwebradio.fm.
It's now time for more Sound Investing with Byron Striloff, Senior Investment Advisor at CIBC Wood Gundy.
All right, we're back with Byron Striloff, and we're discussing what assets will offer protection against rising inflation. So, Byron, if it's not really an inflation hedge as commonly thought, what causes the large prices changes in gold, and is it perhaps viewed more as a hedge against a financial or economic crisis?
Well, the most likely explanation for why gold prices go up is because gold prices are going up. Price changes in gold, they're hard to explain most of the time. When gold is going up, any explanation seems to explain the advance, like a world economy in crisis or central banks printing more money. And when it goes down, suddenly we have a slowing economy in China that seems to explain the drop. I think the deeper issue here is that the most common explanation for gold's rise, and that being that it's a hedge against inflation and money debasement, it hasn't held water for a long time. The rapid rise in the price of gold in the 70s, it was fueled by very easy monetary policies, and we also had negative real interest rates at that time. And when the era of loose money ended, the bubble burst. And here again, easy money, which we've had for 2 decades now, it also appears to be behind the surging gold prices, at least since the early 2000s. Now, while I'm certainly not predicting that gold prices are set to collapse, it's possible that they can fall as well as go up. So just as a change in monetary policy led to a change in gold prices in 1980, if we have a move by central bankers to raise interest rates, that could cause a repeat performance of that dramatic decline that we had more than 3 decades ago. Now, today, gold has risen through a period of low inflation, but I think the notion that gold is a hedge against inflation has been replaced with the more general view that gold is a hedge now against economic uncertainty. But if we look at that, recent events haven't really supported that either. I mean, nothing I'm seeing has changed or reduced the world's economic uncertainty. And I remember looking at the Cypriot crisis where, the whole country had a bank bail-in, and anybody with over $100,000 apparently lost about 60% of their savings. Now, you would think, as I did, that would shake investors' confidence in other currencies enough to send gold up, but it didn't. So many economists, they call the price of gold a fear index, and that's true. Gold tends to rise in periods of turmoil, but the link between the price of gold and real economic conditions seems to be weak. Investors who one moment see a world economic panic and rush into gold can, in the next moment, see a gold panic and rush for the exit. So gold can help offset some economic and geopolitical risks that I've said, but I believe that most people certainly now see gold as a form of insurance against a catastrophic event hitting the global financial markets. And if that were to happen, however, I think it's likely that gold would be of use only to those investors who held it physically.
Let me ask you this way. If gold's not an effective or at least not a consistent hedge against inflation, what assets will offer protection against rising inflation?
Well, and that's a good question, because the next in the list is commodities, which are also often seen as an inflation hedge. However, again, this is almost entirely due to the experience again of the 1970s when we had the creation of OPEC and the fact that energy dominated most of the commodity indexes. So oil did well, but if you held the wrong commodities, their inflation hedging performance would have looked very different. I don't think there are any good inflation hedges in the short term. But over the long term, stocks and real estate have acted as good inflation hedges. As I said, we saw gold reach $900 in 1980, and the Dow 1,000 points at the same time. Now the Dow has reached almost 17,000, and gold at its peak, just below 2,000, today is trading around $1,370. So looking at the numbers, the Dow was a far better hedge against inflation than gold since 1980. Why these people keep saying the same thing over and over again and expect a different result, like, for this time I'll be right, it's kind of a mystery to me. But in fact, if we look at countries that have suffered high inflation in the 20th century, such as, Germany and Italy for sure, stocks still delivered a positive real return in those countries. And real estate value does have a strong correlation with replacement costs, which also rise during inflationary times. So I find the one consistency I see is that gold appears to be more of a hedge in a sense against government, and not so much the hedge against inflation. And by that I mean it has risen during periods when there is an uncertainty as to what paper currencies will be worth, and that seems to be a major concern for most people I talk to today, with so much money printing going on around the world by all major governments.
Now, Byron, this is all just so fascinating. Before we get out of here, though, do you have any last thoughts on gold for our listeners?
Well, actually, I do. I think we all have to give some thought about what's happened since 2008. If I told you back then that the Fed's balance sheet would balloon, fivefold, creating lots and lots of money, what would you have guessed the world would look like in 2013? I mean, really, would you have guessed that we'd see a 10-year Treasury note pay just a little over 3%? Would you have guessed that gold would be trading at $1,370 an ounce approximately? The inflationist view had interest rates in gold much higher, not lower. So something is clearly not right with the Fed's printing money and we're going to have inflation argument. At some point, you have to reevaluate the way you look at the world, or you just sit content to watch things unfold. And in financial markets, that could be quite costly.
Well, Byron, thanks so much for the conversation today. It's been so fascinating, like I said before. Unfortunately, we are out of time. Now, if you, the listener, know someone who would benefit from this conversation we've talked about today, why don't you go ahead and share this podcast with them? I am sure they'll thank you for it. Now, for our listeners, if you need to visit or get more information, you can visit Byron at byronstriloff.com. That's www.byronstriloff.com. And, of course, you can always reach Byron by telephone at 604-535-3700. Again, that's 604-535-3700. Well, Byron, again, for myself, for the listeners, thanks so much for the conversation today.
Thank you very much.
Thanks for listening to Sound Investing with Byron Striloff. To schedule a face-to-face conversation, you can reach Byron at 604-535-3700. That's 604-535-3700 and online at www.byronstriloff.com.
You're opted in to localwebradio.fm. Community-minded, locally focused.